Domino's Pizza reported a quarter that looks weak at first glance. Diluted earnings per share came in at $4.07, below the $4.17 consensus. U.S. same-store sales grew by only 0.1%. International same-store sales declined by 0.1%, and yet the stock initially traded higher after the report. It closed near $329, up about 2.1% on the day. So, why did the market look past the miss? Because the quarter was not driven by stronger sales at existing stores. It was driven by more stores, more orders moving through the system, stronger supply chain economics, and fewer shares outstanding. The miss was real, but the growth engine shifted. To understand that shift, we first need to understand what Domino's actually is. It looks like a restaurant company. Economically, it is a franchising, supply chain, and technology platform. Domino's ended the quarter with 22,531 stores. More than 99% were operated by franchisees. They fund the stores and run the restaurants. Domino's supplies the brand, technology, and food system. The revenue mix makes this clear. Supply chain generated about 61% of second quarter revenue. U.S. royalties contributed almost 14%. So, same-store sales are not the only growth lever. More stores create more royalties. More orders create more supply chain volume. Now look at the reported numbers. Revenue increased 4.3% to $1.194 billion. Operating income rose 3.1% to $232 million. Net income rose 3.6% to $135.8 million. The quarter was not a collapse, profits still grew, but the cash flow picture was weaker. For the first half, free cash flow landed at $313.6 million, down 5.5%. That creates the first tension. Earnings per share grew 6.8%. Net income grew only 3.6%, and free cash flow declined. So the real question is not whether Domino's grew. It did. The question is what produced the growth and whether that mix still deserves the old premium. The bridge gives us the answer. Net income increased by $4.7 million. Operating income added $7 million. Now break operating income into the business segments. The real driver was supply chain. Segment profit increased by $11.7 million, or 18.1%. That increase was larger than the company's total operating income growth. Higher order volume moved through the system, but higher unallocated corporate costs absorbed most of the benefit. Corporate G&A increased by $10.9 million. Now we reach the durable growth question. Domino's is still expanding the system. Trailing four-quarter net store growth reached 995 locations, up from 776 in fiscal 2025. That is real growth. But it is not the same growth investors paid a premium for in the past. U.S. same-store sales were 3% in fiscal 2025. In this quarter, they were 0.1%. International comps went from 1.9% last year to negative 0.1%. In plain terms, more orders moved through the system, but each existing store is barely selling more than it did a year ago. Order volume up, same-store dollars flat. Existing store demand nearly stopped. The broader system still grew because more stores were open and because more orders moved through supply chain. So we should not call this a comparable sales recovery. The positive evidence is that margins held. Supply chain gross margin reached 12%. Trailing operating margin reached roughly 19.5%. The engine is not broken. It has changed. Store count and supply chain are carrying growth while mature store demand is weak. The third quarter will tell us whether that is temporary or the new regime. At the current price, Domino's trades at just under 18 times normalized earnings. Enterprise value is about 14 times adjusted EBITDA, and about 24 times trailing free cash flow. All three sit well below their 10 fiscal year medians. The historical median PE is 30.7. The median enterprise value to EBITDA multiple is 22.6. The median enterprise value to free cash flow multiple is 35.4. That looks like a major discount, but this is where investors can make a lazy mistake. Those historical multiples were earned during a stronger growth regime. Domino's had better comps and faster earnings growth. Today, U.S. comps are almost flat. International comps are negative, and buybacks produced nearly half the earnings per share increase. So the old median is not automatically fair value. Applying it mechanically creates reference prices between roughly $557 and $611. That is not a forecast, it is a regime exhibit showing how far the market has repriced the old story. The analyst targets need the same skepticism. Published consensus is about $400, about 22% above the current price. But most of those targets predate the report. Only 4 analysts have updated since. Those fresh reads land in the low 400s, with the most cautious down at 310, below today's price. Older targets as high as $544 still pull the published mean upward. That is why a target gap is not upside. It is a description of stale assumptions. Targets above $400 silently assume a return toward a premium multiple. That needs evidence, stronger comps, durable supply chain margins, and continued store growth. So here's the final verdict. The miss was real, and the growth engine changed. For a risk-averse investor, the decision rule is simple. Require the third quarter 2026 release to show U.S. comps above 0.1% and international comps above 0. Until then, a historical premium is unsupported. For a risk-tolerant investor, treat the current case as an approximately 18 times normalized earnings store count-led compounder. Do not assume the old multiple automatically returns. The invalidation condition is dated and checkable. If both comp lines recover in the third quarter while supply chain margin and net store growth remain strong, the fading growth thesis weakens. If comps remain flat or negative, it strengthens. Domino's is still a high-quality machine. The open question is whether it is still the same growth machine. If this breakdown helped, subscribe to Valuation Verdict and tell me which third quarter number would change your view.